It's Friday, 20th of June, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, Asia-Pacific commercial real estate, our newest coverage area, why we're expecting a tough recovery for the region's markets. But first, Group Chief Economist Neil Shearing is with me to run through the week in macro and markets. And I'm pleased to say we've got a special guest in the shape of Jonas Goltermann, Deputy Chief Markets Economist. Hi, Neil. Hi, Jonas.
Hi, David. Hi, David.
Neil, I want to start with what's going on in the Middle East. It is the big story of the moment. We've had a week of speculations, been capped by another Trump-imposed deadline. He likes his deadlines. We're at the end of a fraught week. What does the Israel-Iran conflict look like through the lens of global macro?
I think that's the key point here, isn't it? It's through the lens of global macro and markets. We're not pretending to have any kind of insight into exactly how this conflict's going to play out because nobody really knows. I'll come back to that point. Our Chief Emerging Markets Economist, William Jackson, put out a piece a few days ago sketching out different scenarios in which the conflict might play out and then fleshing out what the macro market consequences of those scenarios might be. And it's worth just reflecting on those. There were four in the notes. One is that the conflict dies down over the coming weeks. That seems to be what the US is pushing for with this, as you say, this 2-week deadline. The second is the conflict intensifies, but then ultimately Iran looks for an off-ramp and a way to end hostilities. Third is that it intensifies to the point that you get some kind of regime change in Iran. That's potentially quite a long way off. And then the fourth is that it intensifies and we end up with this drawn-out conflict to which there is no kind of immediate resolution. Now, clearly, there's lots of overlap between those scenarios, the shades of grey between them. But one of the points that came out I thought was really interesting is that the path through each of those scenarios looks similar. So we're not going to exactly know how this conflict is going to evolve and what the end game is for a while. So if you think about the conflict intensifies, the path to regime change, for example, in Iran, will start with an intensification of the conflict. Now, that could end with Iran seeking to end hostilities, or it could end up with a regime change, or it could end in a protracted conflict. But the point being that the pathway to all of these scenarios, at least at the start, looks quite similar. So I think anybody that tells you that they have a sense of how this conflict is going to unfold, I think is being disingenuous. And that brings me to the second point, and it's something we touched on a few podcasts ago, which is the difference between risks and uncertainty. This takes us all the way back to Keynes, of course, who famously wrote about these differences. The point being that risk refers to an event that can be quantified, that the chance of it happening can be quantified, whereas uncertainty is inherently unquantifiable. Now, a petulant president tweeting at midnight about tariffs, that's inherently uncertain, but so I think is this conflict in the Middle East. It's inherently uncertain. It's very difficult to attach probability to any of these scenarios. So we have to think of the scenarios, flesh them out, think about what the macro market consequences are. But as I say, inherently uncertain, and in the first instance at least, will look quite similar because the pathway to each of these scenarios in the early stages looks quite similar.
This whole situation, does it just impose another layer of uncertainty on what was an already an extraordinarily uncertain global macroeconomic situation? And how does that then play out in terms of certainly the next 2 weeks, but even beyond that?
I think it does. Yes, every which way you look, there are events now that I would characterize as, rather than being risks, they're uncertainties. The Middle East is one, Trump and tariffs is another. We've not talked about the US and China and its relationship, but I think that's clearly an important fault line in geopolitics, and that's inherently uncertain given the actors on either side of that relationship. So yeah, it does add an additional layer of uncertainty. The question you asked, though, was what does all this mean for the global economy? And I think in this instance, actually, we know that the transmission mechanism, particularly when it comes to the Middle East, if we stop short of a broader conflict in which the US is drawn in, and even then, actually, the transmission mechanisms really just come through global energy markets, oil, and in the case of shipments through the Straits of Hormuz, natural gas, given big shipments of LNG, for example, from Qatar. So in this instance, the transmission mechanism to the global economy runs through global energy markets. And really, we've seen a bit of an increase in risk premia in oil markets in particular. but not a huge one. We've got Brent, at the time of speaking, Brent crude trading at $77 a barrel. That's up by just under $10 a barrel since before this conflict started, but it's still below where it was this time last year. A bit of context there. Now, if you want a rule of thumb, a 10% increase in oil prices tends to add something like 0.1 to 0.2 percentage points to headline inflation in advanced economies. So we've seen about a 10% increase in oil prices. If sustained, that will add 0.1 to 0.2% to advanced economy inflation compared to a no conflict baseline, if you like. But that's really too small to have a significant bearing on monetary policy decisions, and it's not going to impose a big hit to real incomes either in advanced economies. So at this stage, although uncertainty is increasing, as I say, the implications for the global economy are relatively limited.
Yeah, I saw that Powell got the question quite reasonably about Israel-Iran at his press conference. And he was talking about how obviously the FOMC is watching it. It's possible there could be higher energy prices as a result. But usually from situations like this, you get a spike in prices and then prices tend to come off. And so he was generally playing down the risks to inflation to the US economy. I mean, do you think that's emblematic of how other central banks are looking at this? We've had a gaggle of meetings this past week.
I think that's exactly right. There's some boilerplate language that the central banks tend to use in situations such as these. And that's borne out by recent history too, right? We've seen various flare-ups in the Middle East over the past 2, 3, 4, 5 years. And in each case, you've had a spike in oil prices and global energy prices that has been short-lived, and the pass-through to inflation has been pretty negligible. So in that sense, I think that the response is justified and should be expected. I guess the rejoinder to that is that in each of those cases, those crises blew over and dissipated relatively quickly, which is why oil prices then came back down and why the spike in prices was short-lived. So that the question really is, will that happen again this time? Will this crisis dissipate similarly quickly? If it does, as I say, you'd expect the spike in oil prices to be equally short-lived and likewise for there to be limited impact on inflation.
Jonas, let me turn to you. I must say, it does feel like you only ever come on the podcast when something bad's happening in the world. I guess that's your lot. But Neil's discussed what's been happening in oil prices. Talk about the broader financial markets response to what's been happening. Lots of reactions, quite interesting, as much in how prices haven't reacted as how they have. So what stood out for you over the last week?
Yeah, you're right. I seem to always come on when there's something bad happening, which has made for quite a few appearances this year. I guess that my main takeaway in markets from this whole conflict is it's a noticeable impact, but it's really not that big. If you look at headline equity indices, the bond market or currencies, you're talking about 1 or 2% move in equities and the dollar and so on. And some of that has now unwound today as Trump has punted a little bit on this. I guess there's 2 points to make on that. One is that even the fact that you get a small reaction is notable because usually you get headlines like this in the Middle East, North Korea, what have you, and the market just doesn't move at all because it's not judged to be a big enough risk. Markets, going back to the point that Neil was making about risk and uncertainty, markets are not very good at pricing uncertainty. They tend to just go, I can't price that, so I'm not going to do it at all. And 9 times out of 10 or 98 or 99 times out of 100, nothing bad happens, and that was the right reaction. So the fact that you have seen a bit of a noticeable move here is a sign that this is a pretty bad situation, and that people are worried about it. Now, I guess if you roll it forward and think about those 4 scenarios that Neil was talking about, most of them lead us back to a status quo, no permanent damage, and then, this, to the extent there is anything in markets, are just going to unwind. And the bar for something more dramatic, the oil price going to 100 plus, right? I think that's what you would need for the market really to start taking notice of this, and you see a more substantial drawdown in equity markets and probably a bigger boost to the dollar. I think we're uncomfortably close to that, but it's going to take more than what we've seen so far this week. And until such time that actually happens, we're going to be in this kind of holding pattern where you see bad headlines, you see a bit of a sell-off, and then that unwinds when the dollar moves back towards negotiations.
That's quite clear, isn't it? We've got these scenarios, but at the same time, it almost feels like there's quite a binary outcome that we're looking for in the coming 2 weeks, where either the US joins the conflict with Israel, we get escalation, sharp risk off, dollar up, oil up, or after the deal kicks in and US-Iran move towards some kind of agreement that gives Tehran an off-ramp from its nuclear ambitions. Is that a fair assessment of what the coming 2 weeks may look like? And I suppose we should also bear in mind that just a few days after that, we have the expiration of this 90-day pause on those Liberation Day tariffs. So talk us through the sort of the mechanics of the next few weeks.
So yeah, you're right. There's a lot of things all coming to a head in the next 2, 3, 4 weeks. Obviously you have the Middle East stuff that has taken over the headlines over the past week. And that one, I think, is more of an ongoing issue now. I mean, Trump has put a 2-week deadline, but it's pretty vague what that really means. And obviously there are other people involved as well. The Israelis and the Iranians can escalate all by themselves. And then you have on the US trade policy front, the 90-day pause from Trump's liberation tariffs is coming up in about 3 weeks' time. It's on July 8th, which again has a kind of a binary feel to it, where I think we can be pretty confident that there's not going to be deals done with everyone in the next 3 weeks. That's just not how trade agreements work in practice. So the question is really whether Trump then brings all the tariffs back or extends the pause, which I think is the assumption that is widely held, that he is just going to punt on that until these deals materialize rather than risk another sell-off like what we saw in April. But again, we don't know that for sure. And the other area to bear in mind is US fiscal policy, which again, which was moving markets to a degree at the end of May and early June, has been put a bit on the back burner as the Senate is deliberating on its version of the bill. But we are expecting that to eventually get to a vote. The deadline there, to the extent there is one, is more to do with the US debt ceiling, which is part of the bill. It's a small part of the bill, but that deadline is sometime in August or September. It's not a firm date because it depends on how much money comes in and goes out and so on. But that is I think, the real deadline for the US fiscal bill to get passed. And obviously all the senators and congressmen want to get home for the summer as well. There is this unwritten rule that you're not allowed to have a crisis in August. And I think one of the few bipartisan agreements in the US.
Many times. I remember covering games through 2010s. We had China crises, Turkish crisis. Yeah, you're not supposed to have crises in August, but we always seem to get one.
I guess maybe it's a European rule. The Europeans always put their crisis on hold.
For the Europeans, August is sacrosanct. That's true.
Yeah.
I was going to say the First World War, but I might be aging myself.
No one makes good decisions at that time of year.
Absolutely. But a potentially volatile summer nonetheless. I just wanted to get back to market moves. I did mention that one of the responses to the outcome of this Israel-Iran situation could be risk off, therefore dollar stronger. That would suggest the dollar has assumed its traditional role as a sort of safe haven, somewhere to hide when things go wrong. Neil, you mentioned its response last week, said it was notable. We've seen more similar sorts of moves this week. Does this suggest that what the weakness we saw as a flash in the pan, actually the dollar really is still the linchpin of the global economy?
Yes, I think it does. Clearly, there are some concerns around the dollar's role within the global economy. And we've seen points, haven't we, over the past few months where we would have expected to have risk off and US treasuries rally and the dollar strengthen, but actually that's not happened. We've seen the dollar sell off. But I think in this episode, it's notable that the dollar has seemed in periods of risk off to strengthen and act as something of a safe haven. It's striking, though, that at the same time, we've also seen central bankers, particularly in Europe, trying to push the euro's role as a global reserve currency. We had that op-ed by Christine Lagarde in the Financial Times over the past week. And then some policymakers in France pushing for an expansion of joint borrowing, which would be important because at the moment, one of the things that holds back the development of the euro as a kind of true global reserve currency and a challenger to the dollar is really a shortage of high-rated bonds and an expansion of joint borrowing underpinned jointly, severally by all EU nations would help to address that. So yes, the dollar appears to be acting as a safe haven currency throughout this episode, but there's some evidence, I think, over the past few weeks that policymakers elsewhere are sensing an opportunity to try and push the claims of other currencies, particularly the euro.
Yes, and it's worth mentioning Pan Gongsheng, the governor of the People's Bank of China, talking not so much about a global renminbi moment, following off from Christine Lagarde's global euro moment, but certainly talking about a more multi-currency system, implying, therefore, a sort of reduced role for the dollar implying an increased role for the renminbi in the global economy.
Yes, also notable. And I think some of this is a question of scale, isn't it? Now, if you wind the clock forward 10 years, is it likely that the renminbi, for example, will be used in a greater share of cross-border transactions than is the case today? Yes, I think that's likely. I think the same is probably true of the euro. But the dollar is starting from such a position of strength that it's unlikely that it's going to be supplanted as the principal currency that is used in cross-border transactions. Then there's several reasons for that, which we've got into in past podcasts. But as I say, one of them is the sheer dominance of the dollar at the moment, used in almost 90% of cross-border transactions. So my sense is, yes, both the euro and the renminbi will be used increasingly to settle trade and as a unit of accounting in capital flows as well, global capital flows too. But not to such an extent that it's going to supplant the dollar's position fundamentally, I don't think.
I guess there's one point to add in terms of the dollar's behavior in response to the Middle East stuff specifically, which is that, as we've talked about, the key channel through which the Middle East conflict would affect or could affect or is already affecting to a degree the global economy is energy markets. And that is, I think, part of why the dollar is more clearly a safe haven in this kind of environment, because the US, of course, has energy self-sufficiency, whereas Europe and Asia, the main currencies or the main economies and the currencies there, they're all energy importers, which makes them more vulnerable to this particular risk, as we saw back in 2022 during the Russia-Ukraine war and the energy price spike then. Right? It's one of the underpinnings of US dollar dominance. It's obviously a fairly new development because until about 10 years ago, the US was also a big energy importer, but it's another plank to the dollar's dominance that in situations like this becomes very relevant, and obviously one that isn't going to change anytime soon. Europe and Asia are still going to be dependent on importing oil and gas, a lot of it from the Middle East, for a long time to come yet.
Neil Shearing and Jonas Goltermann there on the Week in Macro and Markets. I should add our usual caveat. That conversation was recorded at 9:30 in the morning London time. That's 4:30 a.m. DC, 1 p.m. in Tehran. And as Neil explained, this is a world of uncertainties. So do take a look at our website for the most up-to-date analysis of this Middle East situation. We have set up a key issues page to collect all of the insight you need on this as we publish, and I will add that to the podcast notes, along with a link to that note by William Jackson that Neil mentioned. But if you're a subscriber to CE Essential or CE Advanced, these are our all-access packages, you can set up a topic alert on this issue so that every time something gets published by the team, you get instantly notified. If you've not done that yet, speak to your account manager and they can help you get set up to track Israel-Iran or any other aspect of macro and markets that we are covering worldwide. Now, Capital Economics was founded in London in 1999 with analysis all about the UK's economy and financial markets. But coverage began expanding almost instantly to take in the global economy and markets and then regional insights through the Americas, EMEA and Asia. Running alongside that expansion has been our commercial real estate coverage. And we're pleased to say that starting in the coming week, the team will be producing coverage of Asia's commercial real estate markets. We'd already been looking at Asian markets through a macro lens, so think Aussie house prices and the consumer, or Chinese developers and financial system risks. So our upcoming launch will build on that work, but also, as Kiran Raichura, our Chief Commercial Real Estate Economist, explains, it'll build out our global real estate story too. Here's my chat with Kiran, and it begins with me asking why we're starting coverage of Asia-Pacific commercial real estate markets now.
In short, client demand. Our macro coverage of the region has been established for decades now, and in that time we've been building out commercial real estate coverage in the US, the UK and Europe, covering sectors and cities in those markets. But we were conscious that APAC was always a missing piece of that global puzzle. Ultimately, the fundamental drivers of the asset class, as well as its ownership, has become much more global in the last couple of decades. And that's reflected in conversations with the large global institutions that we advise. They've been increasingly asking for APAC coverage to round out our global picture. So the coverage we're going to have, that's going to do two things. It means clients are now going to get a comprehensive global view of how markets are performing. and where across the world opportunities lie. And then secondly, as with the rest of our commercial real estate coverage, we are conscious of economy and city level stories that need to be told.
Okay, so responding to client demand, part of a missing piece of the global puzzle, but obviously lots of regional things happening, stories to be telling clients to be paying attention to. But just give us a very quick sense of how our coverage differs from what clients can get elsewhere in the market.
So I was once told by the CIO of a top 10 global insurer that the macro kills everything. And that's sort of our driving impulse at CE. You can't understand markets unless you have a clear view of the macro drivers that underpin them. And that's what we do different. And it's long applied to our CRE coverage in the US and Europe, and will be carried into our APAC coverage.
Okay, so down to the nitty gritty, what exactly is this launch going to look like? What's coming? What can clients expect?
We've got a busy few weeks certainly to kick off with. So we're starting off with an outlook report this coming week. It's one of the standard reports that we provide across our coverage with in-depth analysis and forecasts. But this one will be slightly different in that we're fronting it with a guide to what we think will be the 4 or 5 big stories in APAC CRE, both in terms of their global context, but also importantly, the key winning and losing markets and sectors. And then alongside that, we're launching with an interactive dashboard where clients can view forecasts for all the key variables like rental growth, yields, the total returns. And then we're doing a drop-in, an online briefing the week after, so we can answer client questions from across the region and worldwide. And then after that kickoff, clients can expect a standard steady stream of short and long-form written analysis, again covering the Asia story as part of a global picture, but also the regional stories where we think investors should be paying closer attention. And of course, alongside that, we'll have online briefings and podcast appearances to keep that story flowing, and in addition to our dashboard and our content on our interactive platform.
Okay, I know you've got a very busy week. I know that you're still pulling together the initial analysis, that you're finalizing forecasts. Without giving too much away, what can you give us in terms of sneak peeks that clients can expect?
Yeah, that's right. It's going to be a busy few days just gearing up to that launch. What I can say is that Asia's investment recovery, like elsewhere, is looking like a tough one. So our global story of the new normal level of bond yields are driving a slow recovery in investment activity and in recovery in prices holds true in Asia-Pac as much as it does in Europe and North America. And then within the region, there are certainly opportunities for outperformance, and underperformance, of course. So our analysis, and it's led by Henry Chan, who's recently joined the team to help us build out our Asia-Pacific coverage. He's pulled out some really striking findings. So there is lots happening in the region in terms of the work from home theme that also plays a key role in our coverage elsewhere. And it's having a big impact across markets from Sydney to Tokyo to Hong Kong and beyond. But for now, I can't say much else. I'll have to leave you with that and leave you on tenterhooks waiting for the outlook as it comes out.
That was Kiran Raichura leaving us on tenterhooks ahead of the launch of our APAC commercial real estate coverage this coming week. You should get that inaugural outlook and drop-in invites in your inboxes. But if you do want to learn more about the coverage and speak to Kiran, Henry, or the rest of the team, do get in touch. A couple of events I want to highlight for this coming week. One is about the outlook for Russia's war economy. Liam Peach from our EM team was recently named the most accurate Russia economy forecaster by Focus Economics, and will be celebrating, for want of a better word, that award with a drop-in, that's one of our short-form online briefings, in which he will explain why he slashed his forecast for Russian growth this year as risks to the economy rise. The other event I want to mention is in person. If you're in London on Wednesday the 25th, do come along to our Emerging Markets Roundtable. It's a small group informal chat with clients designed to talk through how these economies are going to fare as Trump tariffs bite, what the rest of 2025 will bring, and what to expect in the coming year. These roundtables invariably wind up with a discussion from all around the room, so it is a really great way to hear from the team, meet with clients from across industry, and find out about perspectives on macro and markets that you may not have otherwise considered. I will add details to the podcast notes, but do speak to your account manager if you are in London this coming Wednesday and want us to reserve a place for you. But that's it for this week. We will be back next week with the latest on global macro and markets. Until then, goodbye.